Real wealth is made, I don't care what asset class you're talking about, whether it's stocks or whether it's real estate or whether it's venture, but from buying great assets and holding them for very, very long periods of time, because that's how your money multiplies.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Welcome to another amazing episode of Raising Private Money. I'm Jay Conner, your host, also known as the Private Money Authority, and I'm so excited about today's show and the guest that I've got. My guest right now, he and his company are managing over $2 billion, that's with a B, $2 million in equities, and he and his company serves over 4,400 investors. So if you're looking to raise private money for real estate deals, or you're looking to be a passive investor, you are here at the right place at the right time. So my guest, he is co-CEO of Origin Investments. He also co-chairs the investment committee and oversees investment relations and the capital raising. Now, before Origin, he had a very prolific derivatives trading career and was named twice in the top 100 traders in the world. And along with that, he's got over 30 years of investment risk management experience. I'm so excited for you to meet my special guest, Michael Episcope, right after this. Well, hello, Michael, and welcome to the show.
Hi, Jay. Thank you for having me, and I appreciate that introduction as well.
Absolutely. Well, you've got so much experience. My audience is going to absolutely love hearing you talk about your experience and your background and, being so involved in overseeing real estate investments and et cetera. But now, first of all, in my introduction, I talked about you being a derivatives trader as far as in your background. You got to tell everybody, what in the world is a derivatives trader?
So that's a fancy word for a futures trader. I went to school here in Chicago. I got a job on the floor of the Chicago Mercantile Exchange when I was about 19 years old and worked my way up. I worked from the bottom as a runner, making, I think, $325 per week, and then became a pit clerk, and then became a broker, and then ultimately got an opportunity to trade for myself in the pits of the Chicago Eurodollar pits at the CME. And it was great. It was the start of just a very prolific career. I didn't know if I'd be good at it. I bet on myself at that time. And some people gave me an opportunity, and I made the best of it. So I did that for about 10 years. And a Eurodollar future, it's now called SOFR futures, but it's essentially interest rates. So I traded the change in the daily interest rate every single day, and I traded what we call back month Eurodollars, and it was fantastic. So, but I got out of there in 06 and moved on to real estate after that.
Well, that's an amazing background and story, particularly to be starting only at 19 years of age and being, introduced to that world of trading. So how do you think that experience that you had in derivatives trading for 10 years, how does that play in or affect or influence your approach to real estate investment and risk management?
Well, I think you said it right there. It's risk management. And I never had maybe a mentor, but I used to be and I'm still a student of the game, and always wanted to understand, why are some people incredibly successful? Why are some people, not so successful in the same industry, having the same opportunities? And so, like, I always read, and I was voracious at that when it came to trading and even real estate. And risk management was something I just intuitively understood. I knew what my edge was in the market when I was trading, and that all translates into real estate as well. And it's about managing risk and taking advantage of opportunities and recognizing those opportunities, having an opinion, but not being opinionated, spreading your risk out, not cross-collateralizing assets, not guaranteeing debt, doing all those things that have really, like even very smart people who have, taken them down. So a lot of what, I think came intuitive to me and made me a good trader is really translated into real estate investing as well.
I know in reading about your background that your beginnings of getting into real estate investing really began with a desire to protect your wealth. So with that being the case, what would you say about how that initial motivation really has shaped your philosophy?
Well, there's a saying, you only have to get rich once. And that's kind of what we live by. And we think about that from our investors as well. And real estate is really about the staying rich, turning your assets into income, doing things in the right way. And it's kind of, both ironic and sad, but real estate is one of the greatest wealth creators out there and also one of the wealth protectors, but yet more people have gone bankrupt investing in real estate or lost money investing in real estate because the market, in many ways has just been the wild, wild west for so many years. So when we think about it, it's about protecting and growing first and managing that downside, making sure that we're using responsible leverage, that we're investing in the right markets, that we're underwriting conservatively, that there's more meat on the bone. And I'll just tell you, we're kind of in the teeth of one of the worst recessions in real estate over the last, certainly in my career, 15, 20 years. 08 was worse because it was a real estate led recession. And we've grown through this whole time. We've been able to produce positive returns. And that was, being proactive. And candidly, it's just using a lot of common sense. And, when we were investing in 2021, it didn't make sense to buy assets at 20, 30, 40% above replacement costs when you can build them. And it didn't make sense, to be in value add or core plus. So we embarked on a barbell strategy of lending and developing. And both of those strategies really helped us navigate this market. Now, we've got a couple, issues like anybody to work out here, but when you're investing through a fund, when, the majority of your deals work, you can handle, a couple that maybe aren't doing as well as others and stuff. And that's the advantage, I think, of being in a portfolio. And that's part of risk management is that we don't do deal by deal. We do have sidecars available for our investors, but we generally invest through funds because they're much more bulletproof than doing a deal by deal structure.
Right. You alluded to the global financial crisis, 2007, 8, and 9 along in there. That's when I had my wake up call and I learned about private money. Not because I woke up one day and said, hey, I think I'll learn about that. It was, out of need with the bank shutting down and I lost all my lines of credit, not due to my record, but due to the global financial crisis. So we all learned some lessons. I learned some very important lessons during the global financial crisis. What are some lessons you would say that you learned from that? And now how do you apply what you learned to your strategies or your investment strategies today?
Yeah, in many ways, we got very lucky because we started Origin in 2007 and timing does matter. We did not have positions on going to 07. I often tell people if we would have started Origin in 03, 04, we probably would have had a lot of risk on, going through 07, 08. It's not to say we wouldn't have been able to manage through. Plenty of people did. When I look at the lessons, I mean, one of, I guess, two of the biggest things, and they're sort of in the same veins. Don't cross-collateralize assets, especially in your funds. And I know plenty of investors who I still talk to, today, who have these stories about, yeah, I was in a fund and it returned zero. Well, that's kind of like impossible if you're adhering to just generally, good risk standards. But when you start cross-collateralizing, meaning that you're giving the bank the pledge of every single asset in your portfolio and you financially engineer returns and you're not really adding value, that's the quickest way to go broke. You can incrementally generate higher returns when times are good, but the risk reward just isn't there. It's not worth, you're going to generate an extra 2% in great times, but you're going to be giving up a complete loss in bad times. So that was a lesson I saw. And then the other one, from a personal standpoint, and my partner and I don't do it. We don't guarantee loans. We do not do that at all. Never have. That's the quickest way to go broke in this market. You can have a period where, they might go fine 5, 10, 20 years. But when you do that, when things go bad and, kind of like in this environment, then you get called by the bank and it's very difficult to recover. And I'll say the last thing here, and this is something I learned when I went back and got my master's in real estate after trading. The best advice for me was never run out of cash either, because if you buy great real estate, you leverage it appropriately, you manage it correctly. All you have to do is get to the other side, because real estate is cyclical. And that, to me, it's not location, location, location. It's never run out of cash, never run out of cash, and never run out of cash. And those are the three most important rules in real estate.
Yes. You mentioned a moment ago, in this, you mentioned real estate being cyclical, but you also mentioned, the market and what we're looking at. So I've got to ask you to reveal to me and the audience your crystal ball. What do you see going on in this market in real estate? What do you see over the next year or so?
Good question, Jay. The crystal ball, that's always tough. We get that a lot on our webinars and things like that. And I will tell you that I'll start where we sit today. And we are in the teeth of one of the worst recessions. We have everything that could possibly go against us. We had, construction costs are up 40 to 50%. Interest rates are, you've got the 10-year now that sitting here today, I think is around 4.7%, which is incredibly high from where it was even 3 months ago. So we've got 100 basis point rally on that side. Transaction volume is low. Cap rates are up. And then there's the supply that's being delivered into the market has never been greater than what we're looking at today. And so that's sort of the doom and gloom, and we're in it exactly right now. I'm actually very optimistic about the next year. There's been a saying in our industry, survive through 25, survive until 25. There's maybe two different frameworks for that. But everything we're seeing, and we do employ something called multilytics, which is we have a team of data scientists who actually crunch a lot of numbers, and they look at every variable possible in the universe to forecast rent growth. And what we're seeing in the latter half of 25 is a recovery in real estate. We're going to see concessions, which means free rent, disappear. You're going to see occupancy improve, and you are going to see rental rates start to go up again. And that is just a matter of they stopped putting shovels in the ground about a year and a half ago in real estate. So you have this massive supply that is really from 21 and 22, but nothing was built in 23 and 24. And we still have a housing shortage in this country. So what our data is looking at, multilytics, is we're seeing above market rent growth in the second half of 25. And I'm excited. I mean, this is when you want to be planting seeds in real estate, especially the common equity side of the equation. That being said, real estate, interest rates are sort of the X factor, and we don't know where those are going to go. And those can definitely derail the party.
Yes, for sure. Well, thanks for sharing your crystal ball thoughts, Sarah, and I agree with you as well. So your company, Origin Investments. So there's all kinds of real estate classes, asset classes, single family, apartments, commercial, self-storage, land. What type of real estate asset classes does Origin focus on?
We are exclusively multifamily only, and we're here for a reason in this sector. It is produced, this isn't even arguable, but the highest risk-adjusted returns across any sector within real estate. And you can take industrial, office, retail, anything, and it's kind of kept up with industrial on an absolute basis. But it's a need-based asset, and it's not going anywhere. And so, like, as a firm, years ago, when we started the company, we were a little more agnostic about where we wanted to be and what asset class. And we used to do industrial, and we used to do office, and we sort of honed into multifamily. And today we build, we buy, and we lend. So we have 3 strategies. We cover 12 markets. We have 65 people kind of growing to 70 at origin. And when people wake up every single day and all they do is think about one asset class and how to maximize the value, it's a huge advantage for an organization like ours, especially at the size we are. We're at 2 billion. We're, have a goal to grow to $5 billion in equity over the next few years. And the multifamily market is big. We're a very tiny fraction of that. And I just believe long term that this is the best place to have your money. You're going to get, you're going to get the upside with a lot less volatility.
When you have individuals that invest in your fund or funds there at origin, and you may have different programs, but is it more or less a straight interest rate return, or do you have equity share percentage on the backside, or what does that look like?
Different funds. So we have a strategic credit fund that is lending, as it suggests. It's credit, and that is for qualified purchasers only in that fund. And that's much more consistent return. But what you give up there is tax efficiency. So that fund right now, I think the trailing 6-month yield is around 11% in that fund, which is amazing. And if you have after tax money or non-taxable money, it's a great investment, but you don't get the advantages of tax efficiency, which is one of the reasons why you want to be in real estate. And our other fund, the Income Plus Fund, is it's a diversified fund. So you're in the common equity position generally in that fund, but we also have debt in that fund and ground up development. So you get kind of all the best of both worlds in that fund. And then as a manager, we are able to tactically adjust that fund depending on where we are in the cycle. So if we go back to 21, 22, we started tilting it towards debt to protect ourselves when we saw sort of what I'll call the irrational exuberance. And then today we're tilting that fund back towards common equity because we believe that, in 6 months to a year and a half, we're going to see another run up in multifamily real estate. And then we have sidecar opportunities, which is all common equity, but individual deals. When we have opportunities for the fund, they might be too big, but we also know our investors, they want deals, they want funds, they want a little bit of everything. And so when you think about our flywheel of products, it's everything for the individual investor. And we have 1031, we have QOZ, we have, the individual deals as well. But one thing we always believe strongly in is internalizing our distribution capabilities and not charging those back to the investor. So in the market, what a lot of people do who are managers of our size is they use the distribution network and they pay expensive wholesalers and brokers to market their products. Now, ultimately, the investor pays for that. So maybe, for every dollar they invest in the project, maybe only 85 to 87 cents is actually being invested in real estate because of all the middlemen. So when we started this business in 2007, we just rallied against that whole distribution channel. And so we're direct to consumer, and we just believe in efficiency, and fees destroy returns. And you got to start with the distribution channel. And that's what we've done.
Right. We've got a large audience here that's listening to the show, and a lot of these people could very well be, considering being a passive investor, want to take a look at your company. But what would you say from your experience are some common mistakes or common pitfalls that new investors face when they're looking to add, real estate to their portfolio?
I think the biggest thing that investors a lot of time, especially individuals, and we see this, they focus on the pro forma, the return potential of the investment, and maybe don't analyze the risk enough or look at the manager or the track record or things like that. And so it's very common for managers to go out there and shop a deal. And you shop a deal by putting an IRR on the front. But what we know about the pro forma is it's absolutely wrong. And anybody who's been investing long enough knows that, a deal that's forecasted to generate a 2x in 5 years, well, that can wind up as a total loss, or it can wind up as, a 1x, a 2x, a 3x, a 4x, but it's going to be somewhere in that range. And it's only after you invest and make those mistakes that do you realize, where the risk was, where the questions are that you weren't asking in that particular deal. And this is not an industry where anybody can forecast with absolute accuracy. We did 5 deals, and I find this very interesting, but back, kind of similar vintages, 22, 23. And all of those deals were had the same underwriting criteria, the same expected return, and they're very different as we sit here today. They're all, from a multiple perspective, multiple on equity, anywhere between like a 1.25 multiple and a 1.7. So you think about that from a profitability standpoint after about 3 years, and it's it's vastly different, even though they all look the same on the front end. And I would say that if you're an investor and you're looking to get into this market, the most important variable is the manager. Who are you investing with? And you want to not even look at the returns, not even look at the projected returns, because a good manager, they are going to number one, probably be conservative, and they're not going to show you what you want to see in terms of the returns. But what they will do is capture the upside and mitigate the downside risk. And it's all about protecting your capital at the end of the day. And that's what you're trying to do. So you want to be with a manager who's been tested. And there's no better time than this last couple of years, because the market has never been worse, probably, in the last 15 years. So I think up until now, nobody had been tested with a cycle, but now plenty of managers have been.
Yeah. You sort of, in a roundabout way, began to answer my next question. So I'll let you do a full answer now. So anyway, what I was thinking about asking you was, there's all kinds of funds out there, right? There's all kinds of managers out there, all kinds of opportunities. But what do you believe really has been the most significant factor in setting your firm apart, say, from others?
Good question. I think that's pretty easy. It starts with alignment and why we do what we do. Number one, nobody has invested more money across our funds, our deals, than my partner and I. And we started this firm to grow and protect our own capital, not to build a company worth a lot of money, not to generate as many fees as we could. And you have to start asking, what's the why? Why does this firm exist? And we exist to help high net worth investors maximize the benefits of owning private real estate. Because when we got into this industry, there just wasn't a firm that was looking out after the interests of investors. And I've had, plenty of bad deals. And that was really what prompted me to start Origin. I invested with others passively in 03, 04, 05, 06, 07. And it was always like 2 steps forward, 1 step back, sometimes getting punched in the face. But I think the motivation of why you do what you do, and then that ultimately translates into the track record and how you treat people, your reporting, your client experience, but your returns comes down to alignment. And that's what you have to make sure, that you and the manager are both rowing in the same direction and after the same thing.
You mentioned just a few minutes ago tax advantages. So what are some tax strategies for long-term growth, protecting your wealth? What are some ways that your firm offers your clients some ways to unlock the tax advantages?
Yeah. Jay, I'll take you back a little bit, because our firm, we used to be engaged in buy, fix, sell, right? Buying, good real estate, adding value, fixing it up, and then selling it and generating IRR. And that was sort of the beginning of our firm. And that a lot of managers engage in that strategy. And I view that as flawed because real estate, there's 2 things about it. Number one, it's very tax efficient, but if you're selling it, then you're not getting the advantage of those tax efficiencies. And number 2, you also want the cash flow. And if you sell it, then you're not getting the cash flow. So instead, you're buying great real estate, you're adding value, you sell it, you pay taxes, you don't get cash flow, you don't get tax efficiency. And what we did about 5 or 6 years ago is we converted to open-ended funds, where we are now buy, fix, and hold. Because real wealth is made, I don't care what asset class you're talking about, whether it's stocks or whether it's real estate or whether it's venture, but from buying great assets and holding them for very, very long periods of time, because that's how your money multiplies. And that's what you're looking to do as an investor. You're not looking to take $1 and turn it into $1.50 or $1.60 and then pay taxes on it. That sounds great. And it feels good because maybe that's a great IRR over a short period of time. But wouldn't it be a lot better to take $1 and turn it into $12 over 30 years? And that's what you can do by buying great real estate, adding value, holding it, enjoying the cash flow, the tax efficiency, and letting the appreciation run its course. And so that's been a huge evolution for our firm, and also a big education portion, to our investors as well. And those who understand it, they're fully in, they get it. They've been down that road. And some people still, like IRR and they chase it, but we have a saying where you can't eat IRR.
Well, just to make sure everybody understands, tell everybody what IRR is.
Yeah, sorry about that. I use industry jargon sometimes. IRR is internal rate of return, and it's a time-based metric. So if you give me $1 and I give you back $1.01 next month, you've made, I think, do my math, it's like a 25% IRR, because I've given you back, 1% in a month, and you time weight that based on an annualized return. And that's how it works out to. So, it works out that you've made a very high, rate of return, which sounds like annualized return, which is its cousin, or annualized percentage rate, but it's not. It's very different. It's a term that's used in private equity and fund management, and it does have its place when you're looking at everything, but it doesn't build wealth, because when you take $1 and you turn it into $1.01, in cents, you haven't really made any real money, even if you're IRR. So that's the idea. A lot of times you're going to want to trade a lower IRR. If you can make 8 or 9% on your money for 25 years, that's way better than chasing, 20% on your money over every 2 or 3 years, paying taxes and continuing to do that.
Yeah, thank you for that clarification. I know we have got a lot of people that want to learn more about Origin Investments and how they possibly can get involved. So how would they go about doing that, Michael?
Go to our website. We make it very easy, origininvestments.com. You can download our materials. You can engage with us right there. You can set up a call with somebody in investor relations. We make it, the user experience is something that we really you spend a lot of time on, and just making sure that all of our information is available so you can make a decision that works for you.
Well, that's wonderful, Michael. Thank you again for joining me here on Raising Private Money. Myself, my audience, we really appreciate your time, Michael. Thank you.
Thank you for having me, Jay.
You got it. And there you have it, another amazing episode of Raising Private Money. I'm Jay Conner, your host. And so that we can continue to have more amazing guests, I really appreciate you liking and subscribing, rating and reviewing. And if you happen to be watching on YouTube, be sure and ring that bell so you don't miss out on any upcoming episodes. And I look forward to seeing you right here on the next episode of Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconner.com/moneyguide. That's jconner.com/moneyguide. And download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.